If you haven't positioned into gold and into silver, you need to change that behavior, because depending upon this stuff is only putting you in the direct line of fire. Blows my mind, frankly. But I do know some people are, oh, well, I don't know about gold. But gold has been around for thousands and thousands of years as money and has held its purchasing power over time, regardless of the changes in all the formulas and all the manipulations. It has maintained that key function, in my opinion, the single most important function, which is to hold its purchasing power over time.
During market downturns or geopolitical risks, investors often flock to gold as a safe haven asset. For example, during the 2008 financial crisis, the price of gold increased by nearly 30% as investors sought refuge in the metal. According to the AI Systems analysis, the price of gold could climb as high as $2,153 by mid-year and $2,353 by the 2024 year-end, a roughly 13% gain from current levels. Lynette Zang, Chief Market Strategist from ITM Trading, stresses gold's enduring role as money for thousands of years, highlighting its crucial function of preserving purchasing power despite economic changes. Meanwhile, Lynette also states the risks associated with fiat currencies, using the example of the Zimbabwe dollar losing its value. Zimbabwean gold producers, along with all other exporters from the country, receive 75% of their earnings in US dollars and the balance in a local currency that lost more than 80% of its value last year alone. As per Lynette, fiat currency is deemed worth nearly zero due to constant inflation and government manipulations. However, she mentions about economic concerns, stressing the importance of relying on gold and silver due to risk in current dynamics. Since 1970, the US dollar, which establishment economists accept as the de facto replacement for gold, has lost 98.2% of its purchasing power priced in gold. The value of precious metals in 2024 may be influenced to an increased degree by central bank policies and inflation rates, which remain high at the end of 2023. Analysts at Standard Chartered give the most bullish forecast. The price of gold could reach $2,300 and silver $36. Lynette Zang also underscores gold's intrinsic value, differing from currencies reliant on government confidence. Now, we present the clips of Lynette Zang's insights from her recent video with ITM Trading Incorporation. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
If you haven't positioned into gold and into silver, you need to change that behavior, because depending upon this stuff is only putting you in the direct line of fire. And I know some people, this blows my mind, frankly, but I do know some people are, oh, well, I don't know about gold. But gold has been around for thousands and thousands of years as money and has held its purchasing power over time, regardless of the changes in all the formulas and all the manipulations. It has maintained that key function, in my opinion, the single most important function, which is to hold its purchasing power over time. You lose purchasing power. The true value of fiat money, government-based, debt-based money, is zero. Zero. You have to keep that in mind. So a rebase is making the inflation appear much better than it is, because they pulled and sucked so much value out of the currency. Gold versus the Zimbabwe dollar. Again, I'm going back to no intrinsic value used in one place when all confidence is lost. It has more value as a napkin or as anything else, as a piece of paper that you can write on, than it does as a tool of barter. And the same can be said for US dollars. Here, $100 used to be a decent amount of money. Now, how much can you buy when you go to the grocery store? And forget going out to eat. I mean, think about how much things cost you. That is really a reflection of this. But this has held its purchasing power. And so They have to take something that has no intrinsic value, is only used in one place. That's it. And is based upon the full faith, confidence, and credit, the ability of the government to grow more debt. That's what supports this stuff. And when they have to pay more interest on that debt, there's your inflation. It's pretty simple. And they have to revalue, rebase it against something that is all intrinsic value because it has the highest level of functionality, the highest level of use, therefore the highest level of functionality. I mean, it's used in every single sector of the global economy. Therefore, there's always demand. They revalue this against this. It's the way that it's done. What are they going to do? Like in Zimbabwe, they revalued the Zim dollar that has no value against the US dollar that's rapidly losing value. So how well does that really work at the end of the day? As long as the Zim dollar is losing value at a faster rate than the dollar, both of them are losing purchasing power value. Neither one of them will protect anybody from any government abuse or any inflation, but this does and will. And that's why, why didn't they bring that out when the normal Zimbabweans had a little bit more money and could have actually pushed into real physical gold in their possession? No, they waited until the middle class was completely destroyed, and only the upper class can afford that. And we see what happens with gold, because this was one day, and that was the overnight revaluation back in June of 2023. And it's not the first one, and it's not the last one, because until the Zim CBDC can be converted into gold, do you really know that they have the gold back there to back it? Maybe they do. Maybe they don't. You think you're getting into Fort Knox to audit? And if you did and you saw a whole bunch of gold bars, are you going to have the ability to audit the ownership sheets? No. But with this stuff, you hold it, you own it outright, and it does not run any counterparty risk.
In crises like Zimbabwe's hyperinflation, Lynette Zang says governments turn to gold to revalue their currency. She emphasizes gold's inherent value, sets it apart from depreciating currencies. Output plunged to a mere 3 tons in 2008, at the height of Zimbabwe's political and hyperinflation crisis. Although production has recovered in recent years, reaching an all-time high of 35 tons in 2022, the country still lags behind its regional peers, despite its significant potential. The country's 2023 gold haul of 30.11 tons fell short of the government's target of 40 tons for the year, showed data from Fidelity Refineries, the state-owned agency which solely processes all the gold produced in the country. Zang cites the example of Zimbabwe using gold coins as legal tender, with a notable increase in purchases by individuals and corporations. Let's get back to the interview.
Confidence is lost, then they bring out gold. And I've had so many people say to me, and I'm about to show this to you, but I've had a number of people say to me, well, Lynette, how do you know that they do the revaluation against gold? Well, it's pretty simple. If you have this that has absolutely no confidence left in it and it's hyperinflating away so the public doesn't want to use it, you have to take something that has no intrinsic value and revalue it against gold money that's used in every single sector of the global economy. So it is all utility and all intrinsic value. And you revalue this against this, and then that is supposed to garner the confidence again. But if this or digital assets or whatever are not convertible into this, it ain't over yet. They're not done. Don't trust it. Don't trust it. So we know that last year Zimbabwe brought gold coins out. Well, by the time they did that, who in the world could afford them? Just the 1%, maybe the 10% in the upper echelons of the community. But their use of gold coins as legal tender leaves roots of economic weakness untouched. Why? Because they didn't change behavior. That's why. But those that could afford the gold, they're certainly benefited from it. As the uptake of gold coins after their introduction mid-year increases significantly, 35% of the coins have been bought by individuals, while 65% have been bought by corporations, including asset management and insurance companies. But I want you to look at this. Why would, 35% uptick by individuals is understandable. I mean, hopefully those that are watching this video have been buying physical gold coins. I know I certainly have been. But why would corporations do this? Because prices in the goods and services that they sell are rising faster than they can increase those prices to the consumer. So with corporations, and we've seen that a bit in the US as well, but with corporations buying physical gold coins, it saves their purchasing power as well, because this is reflected in what's happening in the loss of purchasing power to the currency. So there are strategies that are executed in ITM strategy because it's based upon, upon the historic norm. And those companies that have learned from history, those individuals that have learned from history are actually buying physical gold to hold their purchasing power. And this is what it looks like. Now, this is the Zimbabwe dollar to the US dollar and that revaluation that took place right there, 4/23. So last April, physical gold coins protect these overnight revaluations and devaluations. Now you can say to me, well, yeah, and they used the US dollar to do that revaluation. And yes, they did, except that what do you and I know here in the US? That the US dollar is losing purchasing power as well, right? It's losing purchasing power as well. So out of the frying pan into the fire, it's just that the Zimbabwe dollar is losing value faster than the US dollar at this point. But I believe that that's going to change dramatically. I believe that we've already started the period of hyperinflation.
The outlook for precious metals is optimistic, suggesting a potential upward trend due to market downturns. Due to the historical role of gold as a safe haven asset during crises, such as the 2008 financial downturn, JP Morgan sees a breakout rally for gold in mid-2024, with a targeted peak of $2,300 on expected rate cuts. In the face of economic uncertainties and the potential value increase in precious metals, what steps are you considering to safeguard your financial portfolio? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.